Welcome back to the second video of the futures exchange series where I teach everything futures related. Today's video is going to look at futures compared to other instruments. This would be stocks, bonds, and options. Yeah. So before we start, we should compare futures to financial products. We need to start with the key concepts. Futures are contracts, they are not investments. This is kind of like a reminder. When you buy a stock, you own a piece of a company. When you buy a bond, you're lending money in exchange for interest. And so both of these are actual assets that generate income or represent ownership. On the other hand, a future contract is very different. It's an agreement. You're not buying the asset itself, you're agreeing to buy or sell it later at a set price. Because of this, futures don't pay dividends or interest. They're not used for collecting income or building long-term wealth. Instead, they're typically used for hedging against price changes or for speculating, betting on which ways prices will go. Also, unlike stocks or bonds, which you can hold for years, future contracts always expire. You either settle them or close your position before the expiration date. This is kind of like the fundamental difference. Being a short-term contract-based tool is what separates futures from most of the instruments. Now let's actually talk about each instrument compared to futures in more detail. First things first, let's compare to the most familiar thing you guys should all know, stocks. When you buy a stock, you're buying ownership in a company. You become a shareholder. If the company does well, your stock may increase in value, and you might earn dividends along the way. You can hold that stock for as long as you want. There's no expiration. Stocks are designed for long-term investing and building wealth over time. Futures are different. A future contract is an agreement, not ownership. You're agreeing to buy or sell something later at the price you lock in today, right? Do you guys remember from the last video? There's no dividends, there's no ownership, and every contract comes with a built-in expiration date. Futures are used for short-term positioning, not long-term investment. I'm also going to give you guys let me give you a quick example. So we're going to open this chart quickly. Here you go. So this chart right here, let me quickly hide this too. Right here, this is the SPX, also known as GSPC. This is the S&P 500 index. Right now, I'm also going to add the S, which represents the futures of the S&P 500. And right here, we have SPI, which is one of the S&P 500's ETFs. So on a chart, the S&P 500 index, ticker symbol GSPC, and the E-mini S&P 500, ES, like I just mentioned, they often look very, very similar. This is because both track the same market and their price movements are closely aligned, but they're not the same. Firstly, the GSPC, the one that you can actually see the candles, this one, GSPC, it's a market index. You can't buy directly. Often, if you do want to buy into it directly, you could buy an ETF. In this case, SPY. SPY is in purple. This is right here. SPY is a way to kind of gain exposure. It reflects the value of the 500 companies in the index. On the other hand, ES is a futures contract based on the S&P 500. It basically trades 24/7. It is highly leveraged and is usually short-term traders and an institution to speculate or hedge. So while both charts may look similar, GSPC, or I guess SPX, represents the market. SPY is the ETF that tracks the index, and the ES is a contract to bet on where the market will go, often with leverage and always within a time limit. Now, I just do want to quickly say, you do guys see that the blue one is a little behind. This is not because the futures contract is behind. It's just because I don't have premium on this account, and it's gonna give you a 15-minute delay. Like if I go on Nasdaq, for instance, this has nothing to do. If you go on Nasdaq right here, it's delayed by 10 minutes, I guess, in this case. But that's the only reason it's behind, not because of any other reason. So yeah. Now we're gonna look at futures versus bonds. So a bond essentially is a loan, right? Do you guys remember from the bond lesson? When you buy a bond, you're lending money to a government, a city, company, etc. And in exchange, they agreed to pay you interest, typically every 6 months or every quarter of a year, which is 3 months. This is called a coupon, right? When the bond reaches its maturity date, you get your original investment back, your principal, and your principal. Sorry, you get your original investment back, which is your principal. So over time, you earn predictable interest income and then recover your full amount at the end, right? Bonds are often used by investors who want stable returns and low risk. They're common in retirement accounts and income-focused portfolios. Now, to compare them with futures, there's no loan being made, there's no interest earned, there's no principal being returned, and you're not getting paid to hold anything. That is the main difference between futures and bonds. A future contract is simply an agreement, once again, to buy or sell something later based on what the price is today. It's a trading tool, not a financial tool. Also, while bonds are usually considered low risk, futures are generally high risk because of the leverage involved at the speed at which prices can move, right? In short, bonds are about income and capital safety, and futures are about managing or taking on price risk. Now, this is the most important: futures versus options. These two are very, very similar, but they're very, very different. Okay. One of the most common points of confusion for newer traders is the difference between futures and options. They are both derivatives, right? Meaning they get their value from something else, like a stock, commodity, or index. However, they work very, very differently. The first core difference is a future contract is an obligation. When you enter into a future contract, you are legally agreeing to either buy or sell the asset on a specific date at a specific price. If you hold the contract until expiration, you must either fulfill the contract, which can be something like a physical delivery, or settle the price difference in cash. On the other hand, an option contract is a right. When you buy an option, you're buying the right to make a transaction in the future, but you are not forced to do that. If it's not profitable, let's say, you can simply let that option expire and you're never obligated to act towards it. And so because of this flexibility, option costs money up front, right? When you buy the option, since you might not like buy it, right? The person who's selling you that option has to make some money, right? So which is called the premium. Say the premium to the seller, or sometimes they call it the writer of the option exchange for that right. You're kind of like buying the right. And this will be in the next series coming soon. Like I said, I'm going to make a whole series on options so you guys can learn the full thing and more detail. And obviously, futures don't have a premium. Instead, you post a margin, which is kind of like a form of collateral to enter and maintain a position. There's no upfront cost to buy or sell future contracts, but the risk is often higher. Another very important difference actually is futures move in direct relation to price. If the underlying price moves up $10, your future position reflects that full change. On the other hand, options are much more complex. Their value depends on price, volatility, time to expiration, and a concept called delta, or something delta hedging, same thing. This means even if the price of the this means even if the asset price moves, your option might not gain much value or could even lose a value depending on the conditions. If you also guys do remember in the first slide, I put a definition of hedging, but I also said not delta hedging because that is options, not futures. Just want to put that out there. One last big difference is futures always result in something. If you don't close your futures contract before it expires, you're on the hook for cash settlement or delivery, like I mentioned. On the other hand, options can expire worthless, right? People sometimes, if their option won't make them any money, they just let it expire so they don't lose anything. They just lose the premium they paid. So if the price doesn't move in your favor, you can just let it go, and you'll lose the premium, obviously, but you don't owe anything else. Just gonna say this quickly again. Don't worry about the fancy definitions for options. A series for this will be created soon, explaining them very, very clearly. I do want to build up on this a little bit to show you a quick like visual example. So the nature of both is futures is an obligation to buy or sell, while options is a right to buy or sell, right? That means you don't have to, you're not required to buy or sell. Futures, you are. Upfront cost, there's no premium, but there's kind of like a margin required. A margin required is basically if you want to trade futures, you need to have some type of capital. It depends on the broker and what the CME group has, but you need to have a certain amount of capital in your account to trade futures, right? This is why a lot of funded accounts, the lowest capital is, I'd say, 50,000. I know a couple have 25,000, but the whole point is you need a lot of money to be able to trade futures. This is also why it's very, very hard to just open an account and trade futures by yourself without being funded, because you need to put in a lot of money and it's already a lot of risk, right? You're putting in, let's say, $50,000, $100,000 into account, and there's a high chance you could lose it just like that, if a snap of a finger, right? If you're buying too many contracts and everything falls, or your positions are losing, dude. If if you're in the Nasdaq, right, or so let's say you're in the S&P and you buy 4 contracts with just $1 change in the price, you will be down $200 if you bought it the wrong way. But the whole point is it's very, very volatile, and the price loss or gain is high, right? High risk, high reward. Also, expiration outcomes, futures, they must settle or close before expiry, and then options can obviously expire worthless. Price sensitivities, it moves dollar for dollar, and then options depends on price, time, and volatility. Purpose for futures is hedging or speculation, which I'm going to talk about this next. And then for options, hedging, speculations, or also income. And then when it comes to risk profile, futures have higher, kind of like more like higher, like full exposure, and then options is lower, which is limited to premium if buying. So the main question is why use futures, right? So there are 2 main reasons, like I mentioned already a couple of times: hedging and speculations. So we're gonna start with obvious. Let's start with hedging. So hedging means reducing the risk of unexpected price changes. Whether you're a business, investor, or producer, if your company depends on oil, let's say, or wheat, or foreign currency, price swings can hurt your bottom line. Remember, price swings when a price changes a lot. Let's say right here, we have an example. Let's say we're at a price of right here, a big price. This is a price swing. Right here, we're down. What is that? It's 3.5 cents. Or no, sorry, 4.5 cents. But yeah, that's a price swing. And so by using futures, you can lock in prices now so you're not vulnerable later. This was mainly mentioned in the first video, like I said, but if I were to show you an example, let's say, here, I'm gonna give you an example. Fuel is one of the biggest costs. And so if oil spikes, profits can drop fast, right? So let's say you're an airline and we're at this time zone, right? You're an airline. What you could do is you could plan ahead to avoid surprises, right? So we could buy future contracts right here. And if the price of oil goes all the way to here, well, when I'm buying the actual oil, I'm gonna get them at these prices because I bought a future contract here, and then when the delivery comes, oil can be trading at this price right now, right? But when it comes to me, I bought a futures here, so my price of oil will be less. Yeah, I hope you guys kind of get this. I'm gonna give you another example. Let's say you're a coffee importer. If the coffee prices rise sharply, their cost of goods skyrockets. But if they use coffee futures, they can secure a stable cost in advance. You're buying a price of let's say oil. You're buying the price of oil now to hope that in the future the price of oil, if it increased, you're saving that difference per barrel or per whatever it is. Now, obviously, since you're scared it's going to go up, what if it goes down, right? If the oil prices go down, you're actually paying more than what you could have saved on. But a lot of businesses, they rather paid at that price now, and maybe they'll lose money because oil is cheaper now, but it's better than taking that risk. And if oil prices go up a lot, you're going to be paying a lot more for oil, right? Because businesses are willing to lose this money, and if they could have gone for cheaper, okay, sure, but they don't want to lose more money than they could have, right? This is like the max you will lose if you're buying at futures. What was I thinking? Okay, so yeah, hedging. Oh no, actually, yeah. So the point is, hedging with futures helps businesses make predictable decisions in an unpredictable world. It's all about reducing risk and not making money, like I mentioned. The other thing, the kind of a newer thing, we talked about hedging basically in the last video a lot. But speculation, this is where most traders, especially retailer or like institutional ones, come in. Futures are used to bet on price direction, right? If you believe gold is going up, you can buy gold futures. If you think the S&P 500 is going to drop, you can sell or also short the index futures like ES. You don't have to own any gold or stocks or coffee beans. You're simply trading the price movement, right? This is why I call it price action. I don't know if you've ever seen people trade, but they go price action, price movement, leverage, liquidity. These all kind of are terms built off price and price movement. And so one major appeal of futures is leverage, right? With a relatively small amount of capital called margin, you can control a much larger contract value. This is called speculation, right? That means even a small price moves can lead to larger gains, but it also loses and can add up just as fast or even faster, right? So this makes futures an attractive tool for professional traders, hedge fund, and even some corporations that need short-term exposure to the market. And so kind of to sum up both hedging and speculation, use future contracts against unwanted price movements is hedging, and then uses of futures to profit from price moves you expect is called speculation. But in both cases, it's not about owning the asset, it's about managing or taking on risk. So what makes futures so unique? We're kind of just quickly summarize it. Futures are unlike most other investments you may know. They are contracts, not assets, and that single fact changes how they work, how they're used, and who uses them. With stocks, you're buying ownership in a company. With bonds, you're lending money to earn an interest. With options, you're buying the right, but not the obligation to make a move. In all three, you have control, flexibility, or passive income in some form, right? Futures are none of those. You're not owning anything, you're not lending, you're not choosing whether or not to act. You're committing to a price for set assets on a set date in the future. Hence the fact it's called futures. Futures are used either to protect against risk, like a business locking in cost, or to speculate on price direction, like a trader betting on where gold on the S&P is headed. But there's obviously no dividends, no interest, no long-term passive benefit. Every future contract expires and every contract must be dealt with, either by settling it or closing it out beforehand. So let's say the next time you see someone trading the ES or CL or GC or NQ or MNQ or MES, remember, they're not investing in a company or collecting income. They're trading at price contract with a clock ticking on it called the futures. And that's what makes it so powerful and so different. I hope you guys enjoyed this video and kind of understood the main difference between futures and other ones. I do want to say this again. Don't be worried about options. After the futures section is done, I will start working on the options one, and I'll teach everything I know about options. Thank you.